Hey everyone, while Indian markets were already struggling for last 17-18 months due to expensive valuation, slowdown in earning growth, massive FI selling and negative impact on Indian IT and tech companies due to rise of AI. And just when we thought that the worst is probably getting over, US-Israel-Iran war has sent shockwave in entire global market. And India is no different. But the problem is, this war-related correction is on top of massive pain Indian investors were already facing. Now we all say that volatility is part of investment journey, you need to have patience, but let's be honest, it's been nearly 17-18 months. And now we are in a state of war. Of course, this is not the first time we have seen a global war, but for many investors, this is probably the first experience. And no matter how much we say that don't panic, the fact is market sentiments were already extremely weak and now this Iran-Israel war has further dampened the sentiments. The big question at this stage that many of you might be thinking is, what is the real impact of US-Iran war on India? And how bad is the situation? And most importantly, is this a time to sell everything? So let me share my thought process on this entire development. See, the biggest impact of US-Israel-Iran war on India is due to increase in crude oil prices. India imports around 85% of its crude oil and India is the world's third largest importer. And a significant chunk of that oil comes from Middle East. Crude oil has already jumped around 14-15% in last 2 weeks. So when oil price spike, three things happen immediately. First, our import duty rises, that is current account deficit goes up. Second, inflation pressure increases. And third, rupee come under pressure. Now higher crude means higher fuel cost, higher transportation cost, higher input cost for companies. That can impact the corporate margins. If inflation goes up again, RBI may delay rate cut. And when rate cut gets delayed, liquidity tightens. Market don't like that. So from macro standpoint, oil is the single biggest transmission channel of this war into India. And the biggest concern at this point is Iran has blocked Strait of Hormuz, which is the narrow passage between Iran and Oman that handles roughly 20% of world's oil supply. And if the war continues for a long period and if Iran continue to block the Strait of Hormuz, crude oil prices can continue to jump. In one of the report, Morgan Stanley mentioned that Brent crude could hit $120 barrel if a full-scale Middle East conflict result in a sustained disruption of oil flows through the Strait of Hormuz. Although India's economy today is far more resilient than it was 10-15 years ago, but in the near term, market is driven by sentiments. And sentiments are extremely weak at this point in time. Apart from crude oil impact, another negative impact could be due to FI flow. Whenever there is geopolitical uncertainty, global investors reduce exposure to emerging market. FIs don't sit and analyze India separately in that moment. They reduces risk across portfolio. So even if nothing changes fundamentally in India overnight, capital outflow can increase volatility. And remember, FIs were already selling over the last year due to valuation concern. So sentiment was weak to begin with, and this war just added fuel to an already fragile setup. Now the third question is, how bad can it get? See, honestly, that depends on one variable, escalation. If this remains a limited conflict and does not disrupt the oil supply routes like Strait of Hormuz in a major way, then markets may stabilize after initial panic. But if oil sustain above uncomfortable level for a prolonged period, then yes, earning estimates may get revised down and markets can remain volatile longer. Now at this point in time, the easiest option for investor is to exit everything and come back later when things normalize, isn't it? But in my opinion, selling is not a wise decision unless you are a trader and invested with borrowed money. See, my logic is simple. Let's say you exit today, but then the question is, when will you re-enter? Trust me, I've seen this many times. So let's say you exit today when Nifty is at 24,500. And then let's say it continue to fall to 24,000, then let's say 23,500. So in near term, you may feel good thinking that you did right thing selling everything. But I can tell you that by the time you would realize that everything is fine and let me re-enter, market would already have recovered and would be trading above your selling price. The best example is COVID. Many people sold their portfolio during COVID phase. For few trading sessions, they felt great on selling decision as market continued to fall. But by the time they re-entered, market had already recovered and was trading above their selling levels. And the thing is, Indian markets have already been correcting and consolidating for a long time now. So valuations are already reasonable at broader level. Yes, from here can there be another 5, 10, 15% impact? Yes, possible. But I believe that at current valuations, the risk rewards are much favorable if you have medium to long term investment horizon. And trust me, nobody can time the market. Also, this is not the first time when we have seen a war. Let me give you a very recent and very relevant example. So when Russia invaded Ukraine on 24th February 22, global markets went into immediate shock, and India was no exception. Nifty, which was already under pressure, fell from around 17,500 levels to nearly 15,700 within weeks. That was a fall of close to around 10-12% in a very short period. Yes, mid and small cap corrected even more at 15-20%. Crude oil, which was already around $90 a barrel, shot up to nearly $130 a barrel within weeks. That was 40% spike in crude prices. As a result, petrol prices in India hit record high, inflation surged, rupee weakened, and RBI was forced to go into aggressive rate hike mode. On every single parameter, it looked terrible for India. And if you had watched the news in March, April 22, the commentary was extremely bearish. People were saying this war could last years, global supply chains are broken, inflation is out of control. This is a prolonged crisis. And yet, here is what actually happened. By June 22, crude oil started coming off its peak. By August, September, FI selling started slowing down, and by December 22, less than 10 months after the invasion, Nifty had not just recovered, it had crossed 18,800 level and it fresh all-time high. Although market did correct later for next few months, but then we saw a sustained rally and eventually Nifty touched 26,000 level. Let that sink in. A war in Europe, a crude price spiked to $130, massive FI selling, rupee weakened to all-time low, and yet Indian markets not just recovered, they made new high within the same calendar year. Why? Because India's domestic economy was resilient. Corporate earning, barring a few sectors, held up. Now, I'm not saying history will repeat itself in exactly the same way. Every crisis is different. But the lesson is clear. The investors who panicked and sold in March 22 locked in their losses. The investors who stayed put, or still better, bought during that period, were rewarded handsomely within months. So here is my practical advice for different type of investors. If you're a long-term SIP investor, do nothing. In fact, your SIP is now buying more units at lower prices. That is exactly how SIP is designed to work. So stay invested. If you're a lump sum investor already invested, hold quality stocks, avoid panic selling, and review your portfolio for any fundamentally weak position. And if you have free cash, don't deploy everything at once. Start building position gradually in quality names. So at the moment, obviously defense sector looks like most insulated and in fact a beneficiary of global war. But my only concern is defense companies are expensive. There's no valuation comfort. So defense stocks can do well in near term, but I'm not comfortable with valuation. Then metals like gold can do well in such period of uncertainty. But recently, gold has also shown volatility. And that's probably because market liquidity has dried up and investors are selling gold to cover up their positions. Another factor is US dollar. If dollar strengthens sharply during a crisis, gold can face pressure since gold and dollar often move inversely. But structurally, prolonged uncertainty supports gold. So it can be an added in systematic manner. Overall, I would not try to do anything different in this correction. Maybe just continue to add the quality names that I already hold in my portfolio. By the way, I've recently come across a beautiful slide from Edelweiss that has shown when Nifty returns were stagnated for 18 months, how did the next 3 to 5 years played out? This data is from last 24 years, and if you see barring 2 periods, Nifty has outperformed every time in next 12 months when it has consolidated for 18 months. See, I understand the anxiety. 17-18 months of correction, FI selling, air disruption, and now a war. It's a lot to process for an investor. But I want to leave you with one thought. Every single major crisis in history, and India has seen many by the way, has eventually passed. And every time the investor who stayed disciplined, stayed invested in quality and did not panic, they came out stronger. The Indian economy's long-term story has not changed. Demographics, digitization, domestic consumption, manufacturing growth. None of that goes away because of a conflict thousands of miles away. Of course, the world is tightly connected today and volatility is the price you pay for equity return. And right now, we all are paying that price. That said, the key is to have a diversified portfolio with the right mix of asset allocation and have a longer term investment mindset. Well, let me not stress this video further. If you find this useful, do share it because right now there are many new investors who need this perspective. I'll see you next video. Till then, take care.